Good morning, ladies and gentlemen. Welcome to the panel Banking, Risk and Competition. My name is Aristides Cavalcanti. I'm head of Strategic Management in Specialized Supervision Department, and I will be serving as moderator in this panel. So, to start our panel, I would like to invite Ana Abras to present the work Lakes and Desert Understanding Bank Presence in Brazil. Please, Ana, the floor is yours.
Thank you for the opportunity of coming here and discussing this paper. It's been quite stimulating watching all the sessions. This is joint work with Ben Miller, Joyce Maia, and Bruno Rocha. We sort of evenly divide a group, half of us econometrics and half machine learning. And I'm going to show you what we agreed on over the last year. First thing is understanding what we mean by banking deserts. Banking deserts appear in the literature as a way of understanding places that do not have the physical presence of financial intermediaries. In a large city, you can define it as an area, a couple of blocks, but I'm going to show you with the data how in Brazil it makes sense to define it at the city level. From the perspective of economic development, banking deserts are going to always be a concern because we have evidence both at the macro and at the micro level that the presence of a bank, an intermediary, is relevant for economic development, for firms, and it's relevant for the consumers. There is some new evidence showing that actually growing up next to a bank branch is a way to secure financial inclusion of a household in the future. So we're going to study the determinants of banking deserts in Brazil. Since there isn't a lot of time, I'm going to give you the results up front. We're going to identify the main features explaining deserts. We're going to use machine learning to predict which cities are deserts. And we're going to connect this to the strategy of banks, how they choose to place each kind of service in a different city. And then connect this to a stylized model. Much simpler than what you just watched in the other seminar, but I think it captures in a nutshell why we have deserts in Brazil. Okay, let's... Okay, that's a bummer. Okay, let's roll with that one. The contribution mainly is to use a model that has high accuracy in predicting cities without deserts and find that the common explanations that our priors, what we initially thought would explain deserts don't really work for Brazil. What we actually find is that banks choose areas where they place simpler offer of services like ATMs and service posts as opposed to what we know as a full brick and mortar branch. This combines data from the central bank, the Esteban, where you can see where branches are located in Brazil, combines data with GDP per capita, levels of education at the city level, everything that we think would predict demand for banking services. And we throw in also some information about technology. Our prior was that those things would be related, but less so. Just to have an idea of the differences between markets in Brazil, this is the entire country, all over 5,000 cities. You can see the average size of the market of close to 4 branches is just the average, right? You can go, you can go from having over 2,000 branches, which is, São Paulo, and you have a lot of zeros, which is something that capture our eyes. We also look at information from alternative services, because you want to know, maybe there isn't a branch, but there are credit co-ops, there are peer-to-peer fintechs. So we also add this kind of information to the model. This is what we call isolated markets. They are not in metropolitan areas, and they're distanced 20 kilometers apart. They sort of represent the stylized market in Brazil. And this is what a desert, these are cities that during our sample, at some year, they didn't have a bank branch. And you can see that they're pretty small markets, usually at most 2 branches, and there are almost no alternative services being offered there. So that you have an idea of what this is going to be important, service posts are. Usually if you're from Brazil, it's like a small location that offers simpler banking services, sometimes from different financial institutions. You can withdraw money, you can open an account. It's like the FedEx in the US, you have a full store, but sometimes if you go to a supermarket, you can get a small box, you can post stuff that you bought online. And we're going to see that what banks choose to offer in a city are alternatives. They're going to try to combine places which have a higher level of economic development and where they can offer branches, and smaller cities where they can offer only service posts or the occasional ATM. And so you have an idea of what the model looks like. This is a decision tree. It's the core of the model. You can think of it, you want to make a prediction. And the way of doing it, you start with the whole data. There are 37% of our isolated markets are deserts. And you want to use the features to predict what is a characteristic that is going to help explain why a place doesn't have a bank. And when you go down the tree, you choose the features that are most predictive, and the goal is, at the leaf, you have a homogeneous division of the data set. Blue would be a lake, which is a place with a branch. Red would be a desert. If you combine, if you have an ensemble of trees, you have what we call a random forest. And you can make a prediction of a desert taking votes on those trees and seeing the majority vote. This is what the explanations, the features from the model come out. These are feature importance. And at the top, we can see that ATMs and service posts are the places most predictive, are the features most predictive of deserts, because they are the alternative services that a bank would offer if it's not profitable to have a branch. And what is interesting here is what's not very explanatory of deserts, which is all those variables that we have a prior would be important, like internet access, fiber optic, use of cell phones, mergers and acquisitions. All of those variables, they rank very low in explaining participating in our prediction model. There's another way of summarizing this information, which is using Shapley values. It's going to take each point of the data and see how predictive it is and what's the importance of it in the model. So if you think about a linear regression model with covariates that are non-correlated, this would be the beta. And here, each point is saying this, to the right, it's very predictive of deserts, and to the left is very predictive of lakes. And the further it goes to one side, it has a higher contribution to the prediction. So again, we see this strategy of the banks, which is the services, alternative services they offer, this service posts, ATMs, and lower than that, socioeconomic characteristics of the city, like density of population there, GDP per capita, level of education, average level of education of their consumers. There isn't much time to talk, so to sum up, not talk about the model. We have a prediction setup of where banks are located in medium-sized cities in Brazil. Okay.
You have more time?
You have?
10 minutes, my worry. Just,
Okay, so let's talk more.
just 10 minutes worry.
I don't know why I rushed. So sorry. Let's go back to the bee swarm. This is the prediction of each data point. And we can see here that at the very bottom, we have variables that we thought would be important to explain deserts, and they are not, which is there a microcredit institution operating there? Is there loans and savings placed there? Do you have a fintech? All of those alternative services are actually not relevant in this context. It would be in other places, but the way we interpret this is the specificity of Brazil, in which you have very high heterogeneity. You have places where you have a lot of services, people are using PIX, you have alternatives, the digital banks, and you have places more isolated in the country where people are really using the very basics of banks. Just opening accounts, getting their pension funds. Can we put this in a stylized model? We started thinking about it in terms of markets. Let's say you have a market with a monopolist, and the monopolist has to choose the kind of service it offers and the price of it. The problem with the monopolist is that offering a more sophisticated product has a higher cost, and it has heterogeneous markets. So some places would be interested in this product, and some would not be interested or able to afford it. So the cost function is actually increasing in the sophistication of the banking good. The consumer would like to be close to a banking service of higher sophistication. So in their utility function, theta, which is the level of sophisticated of the market, enters positively, and S, which is quality of good, also enters positively. And this consumer is gonna either get 1 unit of the banking good, or it's not gonna use banking services. We can think of it as the bank offering, simplest thing would be 2 levels of products, a high quality and a low quality. And the way to solve this problem is you have a cutoff point in which a market is gonna have consumers that actually want to use a bank branch and will be able to afford it, and consumers who don't. This would be a separation in which we have lakes and deserts. We can also think of it as there are also markets in the middle, which are markets that could afford low quality good, but couldn't afford the high quality one. Quality, the real value of the good is increasing in the difference in prices. So what we have in this situation is you have a desert that it's in middle of the way. Are the places with consumers that can afford to open accounts and take small loans, and they are in the middle here of the distribution. You have the consumers where the real value of the banking good is something that is high and they can afford it. So there is a lake, this is a city with branch. And we have the desert, which we think of it as a hardcore desert where people will not have any type of financial intermediation. Of course, this is very stylized in the sense that you can always think of people using apps. You know, you can take a bus, go to a different city, try to use the branch. But the idea is that being close to the presence of physical branch has the value of soft information and has the value of learning how to use more banking products. And the idea of the model is really capture the strategy of the banks in which they separate markets according to their type of consumer. I think that's about it. It's the second time I present this. I'm looking forward to comments. Thanks.
Thank you so much, Ana, for your light presentation. So I'd like to invite Daniel Carvalho to make his comments about the work.
Thank you. Yeah, I think it's this one. Thank you. 10 minutes? Okay, so first of all, thanks a lot for the invitation to discuss this paper. It was a pleasure to read this paper and think about this. I think that banking deserts is a really important topic, and I encourage you all to read this paper. I think it's really interesting and an interesting topic. Now, I'm going to take here, as given this focus on banking deserts as places that do not have a bank branch. There's a lot of evidence also in many places, including even in the United States, that sometimes you have bank branches in places, but banks are basically having deposits in that area and moving funds to other regions. So we might still think about these areas, even with branches, some of those areas are still being bank deserts. But I think, having a bank branch is a key thing. So I think Anna did a very good job presenting, so let me just jump into it very briefly what she does in the paper. She's going to use machine learning to predict the presence of bank deserts, so as areas that do not have a bank branch. And then she's going to find that these areas are predicted by some important characteristics, such as the presence of ATMs, service posts that might substitute the presence of a branch. So if you have service posts, you don't need to have a bank branch in the first place. Low population density and other measures of poor economic performance. So banks don't want to open branches in areas which are not very profitable. This is going to include areas that don't have a lot of people or areas which are not performing very well. And I think it's all very intuitive and makes a lot of sense. And I think I've learned a lot from these patterns. Now, I'm going to focus more here on the big picture and not so much in the in and outs of machine learning, but let me just then share my comments. So my first question is about what's the role of machine learning here? So as I understand it, and this is also the points highlighted of a lot of people working in machine learning, including some of the authors that she's citing in her paper, the main advantage of machine learning is that when you have a very complicated problem that is very hard to analyze, there are many variables that might interact in all sorts of complex ways, and it's not very clear ex ante just based on theory exactly what kind of structure you should expect to see in the data. This is very useful because it allows you in a very flexible way to capture that structure, not imposing anything ex ante, to learn from the data, to let the data speak, if you will, okay? Now, in this paper, I think the authors are focused on a few and very plausible intuitive economic variables that make a lot of sense, okay? So I'm not sure how much we need machine learning here if you just, in the current exact results, because I think it's very intuitive that some of these variables should, predict bank deserts, and there are a few variables here that we are considering. So I'm not very sure about what exactly is the advantage of machine learning here, as opposed to just simpler statistical analysis, such as a regression analysis. So with that in mind, I think there's two directions that the authors maybe could push that would maybe make the rationale for using machine learning a bit stronger. The first one is to think more carefully, bank by bank, about where banks are opening or closing their branches. Okay, this is well known to be a very complicated problem when you're trying to optimize this, when you have a large network with all sorts of different characteristics. When people are actually trying to solve models of this, including structural models, they get really complicated, and many times you can't solve. So this is a part where I think using something like machine learning could be very useful, because you're not needing to solve the model, you're just empirically, letting the data speak and tell you exactly how banks are behaving, okay? And I think here you could make also the analysis a little bit richer by looking at different types of banks. Do they have different strategies? For example, state-owned banks, private banks, larger banks, small banks. And you can use all these tools to predict how their opening and closing of branches would be interesting. And this is something that, just on theory alone, it's very hard sometimes to model, okay? Now, the second direction, which I think is interesting, another potential direction, is to focus more on the policy problem of predicting where is going to be the next desert, okay? As opposed to trying to relate desert to a few intuitive economic characteristics, actually trying to predict something that could be useful for policymakers, okay? Now, if you want to go that route, I think I would encourage you also to consider maybe more complex factors that could be here affecting these decisions, not just a few economic variables that are intuitive. And I think that would also help with the rationale for using machine learning. Now, let me focus now on the bigger picture comments that I think I have in terms of both of this paper, and I would encourage also the authors to think more a little bit about these issues also in their research on banking deserts, which I think is an extremely important topic. So I have two broader comments here. So the first one is I think the authors give this impression, and that's my impression after reading the paper, that there's really limited hope for these areas with poor fundamentals, that poor population density, poor economic conditions really make really unprofitable for banks to open branches in these areas. And it's very hard, probably, to change this. Now, when you look at the data, and this is just empirically, there's a significant portion of bank branches decisions that really can't be explained by these variables. So, I mean, given what you can explain, they're mostly related to these things that are intuitive, but there's a lot of things that you can't explain that seem, to some extent, if you will, random. One specific factor that comes to my eye is that there's a lot of clustering, or where banks choose to locate. Okay? This is not data for Brazil, this is data for the United States, but my understanding, working myself with some of this data in Brazil, looking at the patterns, I don't have the figures here, you see some similar things. But this is just showing for the two largest banks in the United States where they have their branches. Okay? Now, if you look at this, you're going to see that there are clearly some places where they overlap a lot, okay, such as the Northeast next to New York, New Jersey, and all of that. But you're also going to see that two relatively similar banks choose to cluster in very different areas. So this bank here, the largest bank by assets in the United States, tends to focus a lot in the Midwest. This bank here has a much stronger presence in the South. Okay? Now, the fundamentals here are the same, but for some reason, this bank here is much more clustered around here than this bank. Okay? Now, you see very similar patterns if I look at the third largest bank here, also in the United States. The clustering, here probably the difference is sharper, is very different. Okay? This bank, for whatever reason, chooses to cluster much more here than here. And you can see the very strong contrast here when if you compare, for example, the second largest bank to the third largest bank. Okay? So banks don't spread out in many areas. They tend to, even the largest banks in a country with very well-developed capital markets here in the United States, they tend to cluster a lot. Okay? So this is not something that you're going to be able to explain just based on the fundamentals of these areas. Okay? There's some amount of arbitrariness here. Okay? So I think this is something important when you're thinking about banking. This is something important when you're thinking about banking deserts. Why are these banks clustering so much in some areas? Is there some large amount of randomness here where they are locating? If there is a large amount of randomness in terms of where they're locating, I think the message about banking deserts might be a little bit less pessimistic. It might not be that hard to get banks to be in certain areas. You might need to give the right incentives and maybe wait some time, and then eventually once you get them there, they might really stick there. Okay? So I think you want to think about issues like geographic specialization, returns to scale. So I think these patterns suggest that there's strong returns to scale for banks operating in certain areas, clustering in some areas. Okay, we don't fully understand those yet, but I think this is something important. There could also be potentially agglomeration spillovers. Some banks tend to stay in one area, that's going to bring more other banks into those areas. Okay, so I think that thinking about this potential randomness in terms of where banks are and where banking deserts are or are not, it's something really important. The picture might be a little bit less pessimistic than I think that the authors are thinking. Okay, it might not be that hard to change some of these locations, given that a lot of it might be arbitrary. Now, we have to understand a little bit better why there's so much clustering and why there's so much randomness in terms of where banks are. Okay? Now, in the case of Brazil, of course, there's a lot of clustering more in the south, southwest, but a lot of this has to do with fundamentals. But outside of these areas, there might be a lot of random differences across these where banks are or banks not are. And even some of these differences between the south and the north, a lot of it might be amplified by some of these considerations, okay, that I encourage you to think more. Now, the other issue that I think, in terms of the big picture, that I think you also want to think a little bit more is about the role, as was already mentioned in this before, of state versus private banks, okay? Presumably, one of the important advantages of having state-owned banks is that they don't worry as much about profit maximizing, so they're going to be more likely to open branches in these areas, and that would be a big advantage. Now, you're showing that they're not. So I don't think that the only friction here is just, low profits in these areas. There might be other frictions preventing these banks from opening branches in these areas, and I think it's important to think about these banks separately and to think more carefully about exactly why state-owned banks that don't care as much about profits are still not opening branches in these areas. So I don't think profits is everything going on here, and I encourage you to think about this. Thank you.
Thank you, Daniel, for the comments. Anna would like to react for the comments.
Thank you for the very detailed comments. I would like to have you as a referee for that. But these are points that we, as a group thought about it, and I'm going to tell you why some of them we didn't want to touch in that paper. First thing is the role of machine learning. I think because we wanted to learn about the data, this was the first step. I actually tried starting with regression analysis and causal inference, and I realized we wouldn't get very far because of the nonlinearities of the data. If you go through the decision tree, you actually have that. If you have only one service post, you are very good at predicting the place is going to be a desert. How do you put this in our standard econometrics framework? I think that's really the issue that put us in the machine learning side of the story, the nonlinearities of the relationship. And the fact that I agree with the point about state banks, it's especially because Brazil is in certain way unique. We have two very large state banks, Banco do Brasil and Caixa, partly publicly owned, and they have more than one role. We know that Caixa Econômica has a role in offering mortgages, and Banco do Brasil has a role of reaching areas where private banks wouldn't go. So and there is actually a lot of literature about Brazil on how private and public banks compete. And what they do is kind of complement each other, which is private banks sometimes offer loans to consumers with higher income. They offer loans to larger businesses. And Banco do Brasil is dealing with small size but very spread out operations. So we didn't want to be in the literature that discussed this problem of competition because we think it's actually a problem of complementarity. And if we go down deeper in the data, yes, the smaller markets, they are more likely to have the presence of a public bank. And it leads to the problem of how do they initially choose and how they cluster, which is, I think initially they almost like politically motivated. You are in a medium-sized city, you'd like Banco do Brasil to reach there. It has a dual role in bringing funding to a medium-sized area. So I think this is conflated in our problem. And to think about clustering, I mean, that's true that banks, they would gather in certain areas, and that's because there's a certain way in which they exchange soft information. You get scale from having more consumers in the area, having more information about their credit. And I'm not pessimistic in the sense that deserts are, they won't get better, they are deprived. It's more like, if you look at the data, deserts sometimes are places where they maybe had a branch at some point. Maybe they had one private bank that wanted to operate there, or one public bank. And those guys scale down to offering just service posts because they realize they can still keep consumers and not spend too much there. They already capture, even to receive the smallest government subsidy, you have to open an account at Caixa. So the way those places operate is that they're not devoid of intermediaries. It's just they don't have the scope to have all products being offered there. So I thought, what we learned from the data was more about how Brazilians deal with the scarcity of intermediaries and how banks chose to offer their services. Okay.
Thank you, Anna. I'd like to invite anyone from the audience to make questions. Please feel free. Here.
I have a question. One is how, if the correspondent bankings are integrated in some way in the analysis, and also I was thinking, what happens if you remove the branches that were created using Banco Postal? So at some point, Banco Postal was Banco do Brasil, and then later it was Bradesco, and then, so I was thinking, because this was a public policy, so if we remove those from the sample, what happens?
Here's the thing, that's a very important point, and we don't put correspondent, the correspondents are those places that you have postal services and they double down and offer a banking service as well. And since we start with Esteban, we don't have the information on banking correspondence. So I think that is actually the missing piece. I knew someone would bring that up. This data is not so I don't want to say organized, but
it's hard to work with, I know.
Yeah. And I am pretty sure if I put this information in the model, it would go way up in the decision tree and be important as an alternative form of, it would be like a service bus. It would be important in the strategy of banks. This is, I would say, the next step.
Thank you. The other questions?
Okay. My question is about the peer-to-peer lending and the credit fintech that you mentioned in the presentation. These two financial institutions, they are not allowed to offer in-person service, so they must be fully online. They can't have a branch with in-person service. So I'm wondering what kind of data and how are you using the data from these two kinds of institutions?
The central bank has the data organized in which they show the location of each branch and each type of service offered. So you're right in the sense that when I measure peer-to-peer and when I measure fintech, it's where they put the headquarters. It's not exactly their consumer. But there is evidence actually from a working paper at the central bank that fintechs, they contest markets, they are important, but they haven't reached a lot of cities yet. I'm not going to get the exact number, but if I recall the working paper, you get them, if you compare traditional banks, fintechs, there are maybe less than 500 cities with actual in Brazil of users of this type of service. So I don't I don't think they're very important in some markets. I don't think they're out there yet reaching the places we are studying, which is the smaller average market.
Sorry, but if this is the case, I think you should not consider not only these fintechs, but also digital banks and even small banks as physical in Esteban. Loans and operations, but all the data is in the headquarters, as you mentioned. So I think you should treat this as not physical presence. It's treated according to
I get it. This is virtual presence. And the thing is, we started with a literature that doubles down on the relevance of the physical presence. I think these are sort of countering problems. We know it's very important, for instance, to have a digital bank to get a certain type of young consumer and someone that maybe wouldn't have much of a credit risk history, wouldn't go to a large private bank. So this is a problem that is complementary. And the evidence is still that the physical presence matter, because digital bank, you don't know your manager, you don't establish any type of old school banking relationship. You don't get there and learn about the other things they offer. They are a different type of animal, let's say. They don't show up, and maybe the point you're raising is a very fair point. They don't show up high in the models because they don't have to be at the city.
Thank you, everyone, for we are on the schedule. I know that we have a lot of questions, but just to follow the schedule, I will make a moment after to make a more broad question. So, to this moment, I would like to invite Daniel Carvalho to present the work, the Bank Risk Channel of Financial Integration. Please, Daniel, the floor is yours. Yeah.
Okay, so first of all, thanks a lot for the organizers for including the paper in the program. It's a pleasure to be here and get the opportunity to present and talk to you. So let me start with some motivation. So financial integration can have important implications for financial stability. A common view is that integration can enhance stability because it facilitates risk sharing. Okay, so for example, if you have shocks with integration, you can spread shocks across different regions, across institutions, and so you're going to be reducing the exposure of each region and each institution to these risks, and you're going to be making things more stable. Now, many economists, on the other hand, have a concern that once you make the world more interconnected with this integration, you can actually, at least under some conditions, increase the importance of aggregate risks. Okay, so the idea is that once you allow this risk to spread, you might actually end up, as you spread this risk with a total shock that might be larger than what you started with, so you might actually have increased aggregate risk. Now, there are different economic mechanisms that could lead to this, but we have very limited, to my best, no evidence on the importance of this idea, this concern with integration, and especially on the mechanisms that could be driving these effects. Okay, so to this end, in this paper, we're trying some initial effort to try to fill up some of this gap. So we're going to study both theoretically and empirically. It's mostly empirical, but there's going to be some theory as well, how bank integration can actually amplify aggregate volatility. Okay, so the idea here that in many sectors, in many countries around the world, there's a significant amount of banking concentration. You have a few large banks that have large market shares, like in the case of Brazil and many other countries. If you look at data for many countries, you see these patterns. And the idea is that this is going to lead to an important type of integration, domestic integration. Okay, this is not across countries that we're talking about here, we're talking about within countries. And this is probably, arguably, the main type of financial integration within countries. So the fact that you have the same bank operating in different parts of the country. Okay, so this is an integration within the networks of these banks. So what we're going to do here is going to propose and test a new mechanism through which this type of integration can actually contribute to aggregate fluctuations in bank lending, the supply of credit, and ultimately economic volatility. Okay? So let me just summarize the basic idea. I don't have time to go in detail over the theory here, but let me just explain the basic idea. So the basic idea here is that banks and as organizations are going to be frequently exposing the different branches of these banks to the common firm level policies. And when I'm talking about here firm level, not to confuse you, I'm not talking about borrowers. I'm talking the firm. When I'm referring to the firm here, I'm referring to the bank, the organization, headquarters. Okay? So it's well known, there's a lot of anecdotal evidence, a lot of empirical evidence that many branches of the same bank are going to share similar policies. Concrete examples, they're going to rely on similar credit risk models. They're going to be usually developed during the headquarters. They're going to have similar rules, okay? This is not necessarily about making decisions centralized. You can decentralize decisions, but you're still going to be decentralizing them using the same incentives, using the same rules for decision makers, okay? There are also many personal policies, incentives of loan officers, internal risk control. That's an important issue with large bank organizations. At least in the United States, for example, regulators are very concerned right now with internal risk controls of the different large banks. Also risk management policies as well. Okay, so the basic idea here is that when you put multiple local banks under the same umbrella, under the same headquarters, they're all going to be exposed to the same policies. So they're all going to be exposed to the same firm level risk. So this is the risk coming from the organization or the headquarters. Okay? And when you have these effects, what you're going to get is that bank integration can lead to a significant increase on aggregate volatility. It can amplify the aggregate effects of these bank level risks. Okay? So let me illustrate this idea with a very simple example. So let's say, imagine there's some banks that had some issues with some of its lending or risk management policies. These shocks don't have necessarily to be negative. In this example, they could be positive as well. The basic idea here is that the more branches you have following the same policies, the largest is going to be the effect of this shock. It's quite simple. So if you have, these policies are being followed only by a few local banks in some area, the shock's going to be contained there. If you have many branches all over the country following these same policies, if they turn out to be less profitable, they turn out to have problems, then this shock is going to spread out. And there's a lot of evidence of these type of problems. Most of the times, when you systematically look, for example, at events, when there are issues with banks, they have to do with a lot of these policies set at the headquarters, not set at the branch. Okay? So what do we do in the theory? So we develop a simple framework to think about this. And the new aspect of our theory here is that we're going to think about the shocks to bank lending. So this is what people have analyzed a lot, including empirically, differences in the supply of credit across banks. We're going to think this as coming from two different potential shocks. Okay? Something that the literature hasn't done much, and this is going to be the key point from our theory to illustrate that where the shocks are coming from is going to matter a lot. And the key challenge is going to be distinguishing empirically where these shocks are actually coming from. Okay? So what's the first type of shock? This is the main shock that has been analyzed in academic literature in most of the debates on these issues on bank integration. And this is the idea. The first type of shock is a branch level shock. It's a shock originating in the branch. Okay? Each branch is going to be giving certain types of loans. And then when you're thinking about a bank, it's just going to be a collection of different branches. So the total branch shock of a bank is just going to be the sum of the shocks across all of its branches. Okay? There's a huge literature in economics and finance, and that motivated a lot of policy debate. The Fed talks a lot about some of these issues, talking about these type of shocks. Okay? And the idea here is that when only these shocks are happening, integration will not increase aggregate volatility. Okay, integration is just going to spread shocks around. It's just going to lead to more risk sharing. It's very intuitive. If I have the same bank in the north and the south of the country, if there's a shock in the south, the bank is going to spread the shocks between the south and the north. It's not going to increase the size of the shock. It's just going to spread it. Okay? Local shocks are going to be spread. They're going to be shared in the networks of banks. So this is going to be good for financial stability. It's just going to reduce the risk which each region is exposed to. Okay? Now, what is going to be different in our theory? We're going to think about also firm-level shocks, and this is what I was referring to, organization level or headquarter. You might label this in different ways. As all these branches are following the same policies, they're going to be directly exposed to the same risks. So the risks are not local anymore. If you put a bunch of banks together, you're not just exposing the headquarters to the sum of all the risks of each branches. You're exposing each branch to the same headquarters that has the same policies, to the same risks. Okay? So what is this going to do? This is going to change this result. So when you have integration now, integration can actually increase aggregate volatility. And what's the idea is the intuition that I just told you before. As you have more branches following the same policies, if these policies go well or go poorly, and there's a lot of evidence on the importance of these policies in driving bank performance. This is the same as differences in productivity across firms. Here are banks, but it's set at the headquarter level. So when these things don't go well, the more branches you have exposed to the same policies. Everyone is doing the same thing. If whatever they are doing doesn't go as well, everyone is going to tank at the same time. So the aggregate risk is going to become larger. Okay? Now, what's the challenge? The challenge is actually empirically distinguishing between these two, something that the literature hasn't done. Because when you see banks lending more or less, it could be driven by these traditional shocks that have been extensively analyzed, or it could be driven by these firm-level shocks. So how do we try to distinguish this? We're going to build on the theory to develop predictions to try to distinguish this. The basic idea is that we're going to analyze area pairs. We're going to look at two municipalities, and we're going to look at the connection between these municipalities when they get integrated. And we're going to use the following prediction that we derive from the theory. So when you integrate two areas, if they become exposed to common shocks that are very volatile, this cannot be explained just by risk sharing, by just branch shocks. This has to be evidence of the mechanism that we are after. Okay? Now let me explain the intuition for this. We have a model formalizing this in the paper. I don't have enough time to go over the details of the model, but let me just explain you the basic intuition. And we think this result is quite general. Let's think about two areas that initially were not integrated, and now they become integrated under a same bank. Now, of course, these two areas are not going to become interconnected, because if this bank is going to have a same balance sheet, and then any shocks to the balance sheet of this bank is going to be moving lending here and here at the same time. So this lending of these two areas is going to start to move together, okay, independently of the shock. Now, what is the key point? So if all banks are doing a risk sharing, so these firm level shocks that I talked about, organization level shocks that are driving our mechanism are not important, what we show is that the volatility of these shocks to banks is going to be limited. And it can never be larger than the volatility of each of these cycles. So going back to this figure here, if banks are just moving shocks around, okay, they're just spreading shocks, the bank is going to be more diversified than each of these regions, because the bank is operating across the region. So the bank will never be more volatile than each of the regions. The bank's just going to be spreading shocks. Okay? So when you connect these regions, they're going to be exposed to common shocks, but these are going to be shocks with low volatility, not high volatility. Okay? And this is always going to be the case. It can never be larger. Now, when we have our mechanism, this flips. So when our effect is important, this is going to flip. And let me try to explain you the story. So the volatility of these shocks that banks are exposing different regions can become actually arbitrarily large relative to the volatility of these cycles. And what's the intuition here? Again, now the bank is exposing these different regions to its bank shocks. Now these bank shocks are not just coming from the regions, they are coming from these idiosyncratic risks, from the policies of the bank. Okay? And these are not going to be well diversified at the level of a bank, because everyone is following the same policies. On the other hand, each region is going to be more diversified. Why? Because you're going to have multiple banks in each region. So in our story, regions are better diversified than banks, because regions have many lenders. Banks are all following the same policy. Okay? So this is how we can get this result that when you integrate, you're actually going to be exposing these regions to very volatile shocks. Now, how are we going to test this? We're going to try to use mergers and acquisitions as a way to have a change in the connection between regions, in the connection of bank integration, to test these predictions. Okay? Now, I don't have a lot of time to go over all the details of the empirical analysis, but For some methodological reasons, we're going to be specifically focusing on the privatization of banks that were owned by state government in Brazil, that many of you here are familiar with. These banks were very large. They represented about a third of domestic credit in Brazil before the privatization. And there's just unique features of these acquisitions that allow us to isolate this effect of bank integration in a more clean manner, okay? But these are very large-scale integrations. So let me just illustrate this with a simple example of the state of Paraná, for example, the Banestado that was privatized. So what is the basic idea at the high level of our empirical methodology? We're going to look here at the acquisition of this bank, where you have a private bank entering this market now, and this is the shares of the private bank increasing a lot. We're going to pick an area here, and as I told you, we're going to be analyzing pairs. So we're going to be looking at how this area here is linked to previous areas from this acquirer. That was a private bank, here in the case Itaú, okay, that was the private bank, relative to a control bank. That was also a private bank that did similar acquisitions, but did not acquire this specific target. So this area got connected to the branches of the acquirer, but they did not get connected to the branches of the control bank. So that's going to be the first contrast that we're going to be drawing here to separate the effect of integration on how these areas are going to be moving together. Now, we're not going to stop here because it's not random where you acquire. And of course, this is all determined by the choices of banks. So this is the key part of our empirical methodology, where we're going to do two other things to try to clean up these results. So the first thing is we're going to use these striking differences here that you can see in this figure between the importance of these banks, these targets, these state banks before they were sold across nearby areas. So if I'm the acquirer, I'm almost getting 100% of this market, but I'm getting very little of this market here. Okay? So we're going to do the same difference between areas where the target had a large presence initially and very close by areas, similar areas where it didn't. Okay? And so the idea is that I'm expanding in the state. I'm not really picking exactly where I'm expanding. And because of the way these banks operate, they're very clustered in some specific areas and not others. So that's the first thing we're going to use to address the selection concern. You're not really picking exactly where you're expanding. Now, what's the other way we're going to address selection? With the timing. You can see these are really sharp changes on the presence of these banks. And as you probably, a lot of you know, this was set by a federal policy. This was not set by the acquirer. Okay, which is usually the problem with acquisitions. The acquirer is choosing, I want to expand in this area because this is a good time for me to be here. It was not the case here. Okay, this was set by federal policy, so this issue is going to help us a lot. So what do we find empirically? I'm not going to go over all the details of the methodology. That's the basic idea of the instrument that we create for bank integration, for connections. We're going to have an instrument for the connections between two areas, how connected they are. Okay, what do we find? Well, we're going to estimate the effect of this bank integration. So this is a connection between two areas, a pair of areas. They're going to be integrated when the same bank has a high share in both areas. Okay, if the bank is only present in one area or just the other areas, they're not integrated. They're going to be integrated when the same bank is present in both areas. What do we find? When areas are highly integrated, they become, this is the first result I'm showing you here, they become significantly more exposed to common large drops in lending. So credit slump here is a large drop in lending. We can measure this in different ways, okay? Now, surprisingly, they don't become significantly more exposed to small drops in lending. They become very much more exposed to very large drops in lending, but they don't become very much exposed to small drops in lending. Now, we can also, our story is symmetric, so it works both for decreases in credit and increases in credit. So what do we see here when we look at increases in credit? We see exactly the same pattern, but basically in reverse. When you integrate these regions, they become significantly more exposed to large increases in credit. Okay, it's much more likely that these two areas experience a large credit boom at the same time, a large expansion in credit at the same time. But you don't see such a strong effect on the likelihood that they experience a simultaneous small increase in credit at the same time. So if you put these two patterns together, what we're basically learning here is that when you integrate two areas, at least in the setting, they become exposed to these very large, very volatile, positive and negative shocks. They don't become exposed to these small shocks, which is exactly what you would predict if the banks were basically sharing risks. Okay? So if you interpret the data using our model, what this is telling us is that you can't explain this only using risk sharing. What's happening here is that banks are exposing these areas to these bank idiosyncratic risks. Okay? If you only had risk sharing, you wouldn't be able to generate this pattern. If all banks were doing was just moving risks around across different branches, you would not be able to rationalize these patterns. Now, these are more the qualitative predictions from our framework. We do a lot of additional predictions. You should see similar things, for example, with deposits, which is kind of counterintuitive, and we do see in the data. There are many other predictions that we analyze. We address controls that this could be driven by the demand for credit as opposed to the supply of credit and all of that. I don't have enough time to go over all of that. Now, I think an interesting thing we do at the end of our paper, which I think is important, is think more about the quantitative implications of this. Okay, the big picture. So the two questions we're interested here is how much bank integration contributes to the volatility of lending here through this specific effect that I just described to you. And second, how important is this potentially in explaining aggregate fluctuations in employment, in the case here in the Brazilian economy? Okay, now we're not looking directly at employment, but we're going to be relying on other papers using data here from the central bank that estimated how much changes in the supply of credit affects employment, and we're going to be putting that into our model to do this type of analysis, okay, at the micro level. Now, I think what is interesting here is that we're not just going to be thinking how much we can explain on what we see, but we're going to be especially thinking about counterfactors. How much volatility should we expect if bank concentration here in the case in Brazil increased further? Okay, if you increase volatility, if you increase more bank concentration, how much volatility we would see more at the aggregate level, and how can we measure the potential magnitude of these effects? Now, these results here, of course, they're going to depend a little bit more in our model than the previous results, just the regression results that I told you. But what we do in the paper is we show that we can actually use our model in a very simple way. We make very few assumptions from our framework to get some of these numbers. Okay, so here in a nutshell are the numbers. They would depend on some specific assumptions here, but they're quite robust. So in a nutshell, this mechanism, we estimate that this mechanism can explain about 20% of the volatility in lending that we observe. Okay, just the fact that banks are exposing these different regions in the country to the same risks. Okay. So if you shut down bank integration completely, the volatility of lending would drop by about 20%. Now, what I think is more interesting, and we see similar effects on employment, what I think is more interesting is thinking about counterfactors. What would happen if you increase concentration? And I think this is probably the most interesting part of our analysis, what we find is that these effects become much, much stronger if you start having further increases in bank concentration. Okay? And I think this should be intuitive. Once you start having very, very few banks, okay, and you can measure concentration for the purpose of our theory here using a very simple measure, the HHI, Herfindahl index at the national level. If you increase concentration a lot, then you have very little diversification of these risks of these banks are exposing because of their policies. Okay, in the limit, if everyone is following the same policy, if that policy doesn't work out, everything will tank at the same time or go up at the same time. Okay? So this is why quantitatively, if you start increasing bank concentration a lot, this effect can become actually quite strong. You can increase volatility by about a third. Okay? Now, the last thing which I think is interesting here is that we can use a very simple measure, which is the Herfindahl index, calculated at the national level, to predict the importance of these effects. This is what our analysis illustrates. Okay? There's been a lot of criticism of these simple measures of this doesn't really capture market power, but for the purpose of our mechanism, this is what it works. Okay? And we find similar effects for employment. I'm going to end here as I'm out of time, but this is all I had to say. Thank you very much.
Thank you, Daniel, for your wonderful presentation.
That's something very important, and I went a little bit fast over that. So the basic idea here is that initially we're going to be choosing, there's two main private banks that we're doing a lot of these acquisitions, which are now the two largest private banks in the country. So we're using one as a counterfactual to the other at each choice, okay? So we're looking at a connection that when one bank is expanding an area, it's creating with the branches of that bank, let's say bank one, we're using the branches, the areas where the bank two is present as a counterfactual, okay? Now, of course, this is not random because these two banks are picking where they are expanding. So this is what I was, I went a little bit over quickly, and, we have to explain this a little bit more in the paper, but this is why we are using the other differences to clean this up, okay? And the first difference is this idea that, yes, the bank is picking to which state is expanding into, but within that state, there's some randomness in terms of exactly where you're expanding, okay? So that's the first aspect. The second aspect is the timing, because this was not set by the acquirer. This was chosen based on a federal program where there were many other considerations at place. If you compare right after relative to before, this might also, the timing might not be chosen by the acquirer. So that would help. So I think these are the two main ways we are trying to make sure that is the right counterfactual. If we didn't do these two differences, there would be issues. But I agree with you in terms of explaining that better. Now, the spatial effects, that's very interesting. I do think that's a little bit beyond this paper, because it's hard to model some of these things. It gets complicated. And, if you start thinking about some of these indirect effects, it can go both ways. You could imagine that if a bank cuts lending in an area, maybe borrowers could go to a nearby city and borrow there, so that would maybe diminish some of these effects. On the other hand, you could imagine some spillovers, where cuts in lending in some area, affects the suppliers of those firms, for example, and then it actually amplifies these effects. It doesn't attenuate. So it could go both ways. I think it's important. And I think thinking about these indirect effects of shocks to banks is really important. I think there's very little evidence on this. And I think that's probably one of the most biggest gaps in our understanding now of how banks affect the economy. Now, in terms of the last point, in terms of the symmetry of the effects, I think that's something interesting. It is a unique prediction. We have to explain this a little bit better of our story, the symmetry. Okay? So let me just briefly touch on that. So what's driving our effects? So when banks have better or worse performance, their equity is going to change. Banks have high leverage. That's including banks in Brazil and banks in the United States. They're very highly leveraged. So when you lose a little bit money in some loans or you gain a little bit more of money, your equity is going to be very highly levered, about 10 times. So that's going to affect your ability to lend. There's even a lot of evidence on this, even in the United States. Okay? In the financial crisis, the main concern, for example, of regulators was the equity of banks, because banks lost a lot of money on subprime securities, and then their equity dropped a lot, and the main concern was to increase their equity. Okay? So the idea is that when banks are following different policy, their specific policies, this is going to create some risk. Things might work out well, or they not, and it's symmetric in our model. Okay? This is not about banks taking more risk or less risk. It's just the fact that banks do things differently. It's just like differences in productivity. And so this is going to expose them to potentially some banks to do better than others. And this is going to be highly levered, and this is going to affect their ability to lend in a symmetric way. That's the basic idea. It's different from other mechanisms. I agree with you. And we're trying actually to distinguish. We have to explain that a little bit better. But thanks a lot. That's very thoughtful. I will think more about the comments.
Thank you, Daniel, for the comments. Now, I would like to invite the audience to make questions. Please, if you have any questions, raise your hands and turn on your microphone.
Somebody else to raise their hands. So I don't think I understand fully the idea of the paper, because I didn't read the paper, right? Of course. But there's something that I was wondering, is if the results are short-term or they're long-term. So I'm thinking Itaú buys Banestado, right? That's the case that you're referring to. And then it chooses to buy Banestado because of, where it's located and so on. And then in some places, Itaú already had a branch and Banestado had a branch, and then that's your setup, right? Then you have two branches that go under one policy. And then what happens if Itaú decides to close the branch? Does it close the branch over time or not? Does it keep the branches? Are your results referring to the moments where there are two branches? Or do they span? This is where I'm going. So I don't understand very well what happens with branch closure decisions, or if they don't, something like that. And also because then it could be that there's something that's called the integration, and another one would be that Itaú chooses to, like organically grow. So I would like to hear a little bit about that. Thank you.
Please.
Very interesting paper, Daniel. So your interesting result that integration increases correlation between large shocks, but not for small shocks. It's interesting, and you seem and you claim that this is consistent with your headquarters level shock. And I would just appreciate some more explanation on that. I was thinking you could think that well, these correlations depend on the policies of the headquarters, but also on the regions themselves, right? So if you think that, for example, banks become more stricter in some rules, for example, they increase prices, maybe some regions can accommodate that or tolerate that and others don't. So let's say one region is more financial literate and sees that those increase in prices don't make sense, they will not accept those loans, and the other region accepts, maybe it's more financially illiterate. So, and this could even be closed regions, one rich and another poor. So this would lead to the end result in terms of the size of credit being different across these two regions and the correlation not so big. So is this a possible explanation why you see the correlation only for large movements and not for small movements? Or are there other explanations? Thank you.
Please, Daniel, if you'd like to answer these two questions.
Thanks a lot for these questions. So the first point on the short-term effects, this is something actually quite interesting because it motivated some other work that I'm currently thinking about. So in a nutshell, and I think this is a bit surprising to me, these things are actually quite persistent. Where these banks inherit their branches, this predicts where they are 10 years later, very strongly in the data. I've checked that. So I don't think we understand fully why that's the case. In principle, you could just grow organically in other places. Now, in practice, if you look at banking, most of the growth, and this is not just in the case of Brazil, in the case of the United States a lot of the aggressive growth, at least most of the time, normal times, if you don't have a large change, massive change in deposits, happens through acquisitions, not through organic growth. And the reason for that is because it's very hard to attract new deposits. Okay, banks struggle a lot to get more deposits. And so a natural way to do that is by buying other banks. So if you look at some of these privatizations, one of the main motivations of these targets when you see they're discussing why we're doing this was to buy a portfolio of deposits. And it's the same thing in the United States. For our analysis, we don't rely on this point. The main thing we're using a 5-year horizon. So we just need these branches to predict where the banks are over the 5 years, because that's the instrument that we are using to predict the connections. So we need this to be a strong predictor, and it's very strong. Okay, the coefficient is almost 1 over 5 years. And so that's what we're using. But I think this is a fascinating topic to understand. Why is it that this is so persistent empirically, both in Brazil and in the United States, the two countries that I'm more familiar with. Banks just don't grow that easily organically in new areas. That's just the empirical fact. I'm not saying I have a great explanation. Now, in terms of the correlation, I think that's a nice way to summarize what we find, that when you connect the two areas, you increase the correlation between these large shocks, but not the small shocks. Now, the basic idea, and there's issues with the empirics, is that we are controlling for everything else. Okay, if you buy our analysis, I'm not saying you should. If you buy our analysis, we are controlling for everything else. So everything else constant, if you connect two areas and they start moving, it can essentially be only because of one of two reasons. One reason is maybe because the two areas become more similar, so maybe there's a demand effect. We do a lot of tests to try to rule that out. We don't seem to find that, and I don't think that would explain this very large correlation across very large shocks. So the other reason what we're left with is that these two reasons are now exposed to lending by the same bank. So these effects, at some level, if you buy it empirics, they have to capture the fact that the banks are exposing the two areas to the same shock. So the question is then, what's the volatility of this shock? And our main point is that if these shocks, if it's all risk sharing that's going on, then the volatility of these shocks has to be small relative to the volatility of each area. And that's the result from the theory. Why? Because if banks are just spreading shocks around, the banks are going to be relatively well diversified. I'm in 10 areas, and I have a relatively good portfolio of areas, and areas will be more volatile. So that's the basic result from the theory. So if we see the integration actually exposing these areas to these volatile shocks, if you believe our results, then the only explanation left is that the banks are exposing these areas to these very volatile shocks coming from the bank, not coming just from the branches. That's the basic idea. But I agree, it's a big if we're really controlling for everything else. But that's the idea of the empirics.
Thank you, Daniel. Thank you very much for all authors here. And on behalf of Central Bank of Brazil, I would like to thank you so much for the papers. It's very, very worthwhile for our conference. Thank you so much.